What's going on, guys? Welcome back to another video, and in today's video we're going to be talking about entries as well as framing the perfect entry when it comes to a trendy market as well as a reversal market, right? Where a lot of traders struggle at is framing a sniper entry. I know where the marketplace is most likely to establish a low or high based off of market structure, and in this video I'm going to give you guys the exact framework and the exact blueprint that I use to catch really good entries so I can have tighter stop losses but maximize on my winning trades. And I'm going to give you guys that same blueprint that you guys can implement into your own trading, so hopefully you guys can learn from this, backtest, implement into your own trading, and hopefully pass your funded accounts and make your first $10,000 trading. But before we get into the video, make sure you guys follow me on Instagram at Arkhamtrades, as well as if you guys want to invest in your education and trade with me live every single morning, as well as access to a full curriculum top to bottom shared nowhere else on YouTube, you guys can join Spark Train University. That's going to be a first in the description. But with that all out the way, let's get into the video. We have a price leg. One is going higher and one is going lower, and we're anticipating a retracement for a continuation move. One trader may find themselves taking a trade based off of a slight pullback entry, and another trader may find themselves waiting for a deeper pullback entry. Despite both traders having the same narrative in terms of direction of the marketplace is going to go, one trader is going to get a setup while the other trader is going to lose or miss out on an entry. And how can we put ourselves to be in a position to where we can capitalize on the proper setup and not miss an entry? Well, we can use two things. The first thing we can do is identifying our dealing range, and the second is identifying a draw on liquidity. A dealing range is identified when we take out both sides of liquidity from a point where we can anchor a Fibonacci from the high that took out a previous high and a low that took out a previous low, and we get our premium to discount ranges, with 50% being our equilibrium. And our draw on liquidity is simply our objective to where we anticipate price to go next. I've been taught for the most part that the dealing range is we wait for price to come back to the 50% and we take a trade in a premium or discount before continuing higher or lower. And simply that is true, but there's also another way to use the dealing range that not a lot of people know about that I'm going to share with you guys today. The other way that we can use the dealing range is respective to our draw on liquidity. When price has a draw on liquidity that is further out, price will not come back to the 50%. Instead, price will remain above the 50% of the dealing range. Same thing if the market is trending, right? If the market is trending higher and higher, why would price come back to the 50% when the marketplace is clearly trending in an upwards direction? It should not give any steep pullbacks or movements, as the goal of the trending market is to be one-sided, meaning if you're in a bullish trend, only buyers are making money, and if you're in a bearish trend, only sellers are making money, and the other side will suffer good consequences for selling an uptrend or buying a downtrend. So if your draw on liquidity is all the way up here and we're in an uptrend, price is going to refer back to inefficiencies above the 50% of the dealing range. And if our draw on liquidity is a lot closer, price will then come back lower into the 50% of the dealing range before going into your draw on liquidity. So it's all reflective on, is the marketplace in a trending pattern and where is our draw on liquidity. This first depiction, our draw on liquidity is all the way up here, and we can see the marketplace is clearly trending higher. So the market is going to remain above the 50% of this dealing range before finding support to then continue higher. While in this case, the draw on liquidity is a lot closer, so we can see this massive impulse to the upside. Price comes lower down into the 50% before continuing higher. It's all reflective on where is our objective. Is the marketplace in a hurry to get there, or is it not so in a hurry? When it's in a hurry to get somewhere, it's not going to come back to 50%, but when it's not in a hurry and it can get there quite easily, it's going to refer back to the 50% most of the time. So if the objective, which is to draw on liquidity, farther away, and price has to get there in a quick manner, it's going to do so quickly, giving slight pullbacks. It's simply not going to give a massive pullback, so we have to anticipate a slight pullback until our objective is then met. Then when we shift course, as you can see, giving the slight pullback to now higher prices, and the same thing, we're in a trending market going higher and price giving slight pullbacks until it then reaches our drawn liquidity. After the market is no longer trending and not in a position referred to as in a hurry, it will then retrace back into the 50% of the daily range before closing off. So as the marketplace is trending lower and trending higher to its drawn liquidity, don't expect a big pullback, right? Expect minor pullbacks continuing to trend higher above the 50%. But if price is not in a trending condition and isn't in a hurry to get somewhere, and the range is a lot smaller, then we can anticipate the pullback into the 50% of the daily range before seeing a continuation lower or continuation higher. Hope I was able to explain that in a manner to where you guys were understanding. But if you guys still are confused, don't worry, I'm gonna head onto the charts. I'm gonna show you some live examples as well as a live trade that I taken using this exact framework that you guys can also apply. So if you guys are getting any value from this, make sure you guys hit that like button as well as subscribe if you haven't already. And if you guys want to be a part of an elite community, you guys can click the first link in the description and join SparkTrain University, right? In SparkTrain University, we have 60+ lessons, over 30+ hours in a detailed top to bottom course, daily live education with all of our students, weekly progress calls with all of our students, as well as a complete roadmap top to bottom to ensure that we hold every student's hand until they become consistently profitable, right? Don't go another year, another week, another month being a failing trader and doing the wrong things. Come to us at SparkTrain University. Let me and my brother hold your hand and help you every step of the way until you become that consistently profitable trader and make the decision to invest in your education. That's going to be a first link in the description, or you guys can go to sparktrainu.com. Now back to the video, and we're looking at the Dow Jones, and this is a trade that I actually took this morning, which made me over $7,000 in only 30 minutes. That I'm going to break down exactly how I did it and how you guys can use the same framework. So we understand that we have been making lower and lower prices on the Dow Jones, reaching a level to where the marketplace is simply no longer pushing any lower, as well as we do have areas of inefficiencies above us. Take note of this 1 hour bearish fair value gap, as well as we can take note of the prior daily high right up here. So these are clear draws on liquidity, balances and prominent highs and prominent lows inside the marketplace. These are draw on liquidity points to where we're anticipating the marketplace to reach up into. So we can use this low point, which obviously swept these previous lows just like so, reaching back up above these highs, right? Usually traders would say price to come back into a level of 50%, right? Come back into the 50%, and then we can see a continuation higher. In the cases, right, that could be true. But in this scenario, price has a drawn liquidity up here and all the way up here. Price is not going to come all the way back down to the 50%. No. Price is going to react off of the most recent imbalances above the 50% because it has a long way to go, right? From right here to all the way up here is over 200 points, right? Over 200 points that the marketplace has to reach back up into. So why is it going to come all the way back up here and give sellers room to breathe to short the marketplace when they can take it for a slight pullback, and do the short traders thinking the marketplace is going to go even lower, simply take them out and then see this push to the upside? So my overall reference was price was going to hold above the 50% of this daily range and potentially react off of this bullish fair value gap for a continuation to the upside, reaching back up into this 1 hour fair value gap as well as the previous daily highs, because we can see price failed to take out the previous daily lows, so now it's referencing back up into the previous daily highs. So if we come back down to the 15 minutes time frame here, we're anticipating price to come down into this level, give some type of bounce for a continuation to the upside. price came lower into that 1 hour bullish fair value gap and then gave this bullish engulfing candlestick to the upside, signaling to us that price has found support at this support level and we're most likely in a market maker buy model. And our draw on liquidity is simply that 1 hour fair value gap up here. I hope you guys remember that, plus these previous daily highs, the most recent PD arrays, to then use as entry points to then reach back above higher prices, right? We're not going to wait for price to come all the way back down here. No, we're going to use the most recent PD arrays because price is in a hurry to reach a specific point inside the market. So in this case scenario, as 9:30 is about to open up, I had my limit order around this order block level, which is also inside of this 15-minute bullish fair value gap. And I had my stop loss just back below these previous lows, reaching back above the previous daily highs for over a 3-to-1 R. This was my setup that I taken with the live trading team inside of Spark University, and let's see how this plays out. As you guys can see, price came into that 15-minute order block opening, following this push to the upside, and seeing how we got this bullish engulfing candlestick, I then scaled into my position, giving my new entry back up here, readjusting my stop loss just back below this order block low, as well as putting my original entry back to break even, reaching back above these higher prices. Now, instead of a 3-to-1 R, I'm capitalizing on this winning trade, making over a 4.5 R on this winning trade setup. And let's see how this plays out. And as you can see, just like that, price gives a massive push to the upside, reaching back above higher and higher prices, right? Let's say you missed this original entry. You can set up your dealing range here from this previous low to this previous high right here. And as you can see, price remains above the 50% of this dealing range. What I see a lot of traders do is they'll put their entry at the 50% of a fair value gap, not understanding that as price is in a hurry to get somewhere, it's not going to come back to the 50% of that fair value gap. I'd much rather you guys take the entry at the opening or the 25% of the fair value gap rather than putting your faith and trust into the 50%. But that's going to be a first example. In this one trade setup, this made me a little over $7,000 in just 30 or so minutes with the live trading team. And if you guys want to trade live with me every single morning with me and my brother Spec Trades, you guys can click the first link in the description and join Spark Trading University and get access to the full curriculum, live trading, weekly progress calls, and so much more. But if you guys only want live trading and don't want anything else like weekly progress calls or the 60+ lesson curriculum, you guys can just join my Patreon for $45 a month. That's going to be linked in the description. You guys can get access to live trading and take the exact same trades that I'm taking and hopefully pass your funded accounts and so much more. Now let's get into our next lesson. We're looking at gold here on a 30 minutes time frame for our next example. And when we're identifying our dealing range, remember it's from sell side liquidity to buy side liquidity or buy side liquidity to sell side liquidity. We're using the most recent points that took out a level of liquidity. We can see we have this low which took out this low before seeing this push to the upside. So we would anchor our Fibonacci from this previous low, reaching back up above these previous highs because we took out previous buy side liquidity points inside the marketplace before anticipating a retracement. And as you can see, gold is currently trending to the upside, and we have a clear draw on liquidity above us, which is his previous daily high. So obviously we can see gold is in a position to where it's trending higher and higher and higher and higher, reaching up into this point. So price is not going to give sellers the opportunity for a deep pullback. It's not going to do that. It's going to remain up above these levels, above the 50%, so buyers can continue to buy, continuing to see the trend, because sellers are most likely seeing this as a position to where they could then short the markets or short the highs, right? We know how retail traders are, right? They try to short as the market's going higher based off of it's oversold or overbought, not knowing the entire context behind the market. But as ICT and SMC traders, we understand the overall context. So the context is prices reaching higher and higher prices, reaching back up above into this high point, That is our narrative, and our overall order flow is we are trending higher and higher and higher. So price is not going to come all the way back down into a level of equilibrium. It's going to stay above the 50%. It's going to refer to most recent PD arrays as the levels of support. And the first PD array that kind of catches my eye here is this inversion fair value gap. So we can clearly see that price has broken above this level of resistance. So now we're anticipating price to come lower and act this level of resistance to now see it become a level of support to then see a continuation to the upside, right? Inversion fair value gaps are very, very powerful. As well as inside of this inversion fair value gap, we can identify this order block level just down here. So this would then be classified as a nested PD array. So as we can see, we have this inversion fair value gap level, and inside of it, we have this order block level above the 50%. This would be a very, very solid entry here, right? As price comes down into this order block level to then take longs, stop losses back below here at the 50% of the daily range, because we're confident price is going to remain above the 50% of the daily range and not see a steep pullback, because the marketplace is currently trending, reaching back above these highs here for about a 2 to 1 R. And let's see how this trade idea then plays out. We can see price comes down into that order block level. And just like that, as you can see, price reaching back above these highs, remaining above the 50% of this daily range, continue to see that bullish momentum higher and higher and higher, right? When price is trending in an overall direction, higher or lower prices, it's not going to give a steep pullback. It just won't do it. It's going to remain above the 50% of the daily range, hovering above that level, continuing to crawl higher and higher and higher. Now let's look at our last and final example. Look at our next example here on USD JPY, and we can clearly see that the marketplace has saw this massive push to the upside, and then we saw this breaker structure to the downside, as you can see, breaking back below these lows, signaling to us that price is coming back down into this imbalance. When we have massive imbalances inside the marketplace like this, you guys always want to refer to them as quadrants. And we have the 25% here and the 50% of this imbalance. At the moment, let's target back into the 25% of this imbalance. So this is a fairly close draw on liquidity, right? This isn't like we're trending all the way down, right? There's no trend here, right? This is simply a breaker structure anticipating a pullback for a push lower, right? When we have a decently close draw on liquidity, as you can see right here, plus we're not necessarily trending one direction, this is more likely a reversal, we can now refer back to the 50% of the daily range. So we can anchor our Fibonacci from this high all the way down to this low here, and we can get, as you can see, above the 50% here would then be our premium. And inside of this premium level, we do have this bearish fair value gap. Stop loss just back above this fair value gap high, as you can see, reaching back below into the 25% of this imbalance for about a 2.2 R, right? Keeping things very simple and robust. Let's see how this plays out. And just like that, price comes all the way down, reaching down into our area of take profit after coming back into a level of premium inside of this bearish fair value gap. As we can see here, this was a classic reversal setup. Price came higher, swept a level of liquidity, gave a breaker structure to the downside. So when we're in this situation, we have a clear draw on liquidity that's not far from us, that's actually pretty close. Price is going to refer back to the 50% of that daily range for a retracement move lower, right? When we're seeing a reversal setup like a super liquidity breaker structure, that's when we can use the 50% of the premium to discount range. But if we're in a trending market where price has already given the reversal and is already going higher and higher, we want to refer back to above or below the premium discount range, right? Above or below 50% for that continuation of the trend. But if you guys are catching the reversal like a sweep liquidity breaker structure, then you guys can wait for the pullback into the 50% with an inefficiency in alignment. And if you guys want to join Spark Train University, that's the full curriculum, and make the investment in yourself and your education. That's the first link in the description, or go to sparktrainu.com. And if you guys want access to my free course and my free ebook, that's also going to be the link in the description as well. I'm Arkham. Be safe, guys.